Welcome back to the channel, everyone. Guys, this video is going to be a little bit more informal than I normally do. Just kind of doing it on the fly based on what I know and the exact kind of techniques I use, top level, to start getting a good idea as to whether a business is a good business or a bad business. In today's video, I'm going to cover off Kogan. I've had a few of you mention it in the comments. And a lot of the online stocks recently have been hit pretty hard. Like, for example, if we look at Kogan, now this is Kogan's website here. I thought I'd bring it up for those of you that don't know. They sell a whole range of products, guys, lots and lots and lots of different products. Arguably though, they're mainly, and started off mainly being an electronics goods retailer, mainly TVs, home theater, cameras, all those sort of things. And even a few appliances and stuff like that is what they started off with. They sell pretty much everything now. They're kind of becoming our Amazon to an extent. A little bit different to my deal because they probably a bit of a less emphasis on, say, furniture. But I believe the space is big enough for all of these players to exist, as well as things like Amazon. I mean, if you look at the US, there's quite a few different players playing in that space, and while Amazon is the biggest, there's still some other really, really big companies. Now, Kogan, if we come over to Yahoo Finance, just been doing a bit of a digging into this business. If we have a look at the last, say, 5 years, it's had a pretty good run. You know, from 2016, it was, what's that, $1.52, all the way to the high in September of, say, $20, or August, $20.80. Since then, obviously a pretty big drop, right? We've come down to $12.74, and this doesn't seem to be abating yet. There's been a little bit of a recovery, but to be honest, guys, it's not convincing me yet from a chart point of view. I'm not really a technical analyst, guys, but you know, when there are highs here and it hasn't quite hit this point here, I'd want it to pass this point up here. So what's that? Just over $13. It didn't quite do it here. If this low and hits a lower low here, this might be what's called a dead cat bounce, and it may head lower. And the reason I wouldn't be surprised is, guys, this here seems to be the next level of support up here around the $9 mark. Now, while I think this business on a financials point of view, using financial analysis at 1.35 billion, PE of 30.9, at the rate it's growing, guys, and the industry it's in, I think this business is actually quite a good buy at the moment. But I'd really want to see these online retailers start to kind of trend in the other direction. And what might cause this would be good earnings, right? Now, our earnings season isn't here yet. It's a couple of months away. So I wouldn't expect Kogan to report for another probably 3 months, maybe 4 months, but probably 3 months. And so until then, we don't know what's going to happen, right? Unless they give us a nice, good update, we just don't know what's going to happen. And we will look at recent announcements in this video as well. But really top level, the 52-week range actually says here it's 25.57. The low was 5.89. So even still, right, if we go a year ago, it's still up significantly on a year, right? You've doubled your money in a year, which is pretty bloody good. Now, this pullback, obviously if you bought here, not ideal, right? You've lost half your money. But time in the market versus time in the market. So this stuff can be quite hard to time. If you are still in it, I probably wouldn't be selling right now, me personally. I'd be holding this probably for the longer term. And I mean, for this to have a forward yield of 2.46%, it's a relatively fast growing business. So me personally, I think it's, for a long-term holder, this is a good buy. But let's look into the business a bit more and have a look and understand it. So let's jump into Comsec. We'll look at the buyer-sell spread at the moment. So there's a lot more buyers than sellers, and for a lot more units, which kind of is implying that, you know, potentially this is starting to turn. But I mean, on a day like today, it actually dropped back again. So it's still definitely in a downtrend, guys. It's not something I'd be eager to jump into right now, but me personally, I'm already in my deal. I'm down on that, obviously, significantly. And I bought that because I bought it after the IPO, a couple months after, so I didn't get in at the top, but I definitely didn't get in at the bottom. I think I bought it around $1.10, $1.15 from memory. Definitely down, but I think longer term, both of these businesses will do well. I myself am in the online marketing space, so I believe that they will pick up and their earnings will be good, and that investors will come back to these stocks, because this is where the future is. Let's be honest. The future isn't in bricks and mortar, even JB Hi-Fi and things like that. While they're good businesses, if they lose sight of the online business and the online component, don't be surprised if you start seeing things like Kogan stores, My Deal stores, Catch of the Day stores and stuff like that. And some of them have already toyed with this. Now, if we go into financials, let's get a little bit of an understanding for the business. Now, I always like to see this, right? So earnings have been going up significantly. Return on equity came down last year. That would be something I'd want to know why. It was on the up and then it came down. Sales per share has been climbing steadily, guys. And I think the reason a lot of online retailers have been hit is because they believe that the big boost they got was because of COVID. Now, I don't think that's the main reason. I believe that there's definitely more growth to come, and we will look at their most recent earnings update and have a look at how they went. Cash flows up, which is another good thing. Earnings are up. Dividends are being increased. There has been a little bit of shared dilution here, which isn't great, but still great returns, guys. So still up 219% in this period here, significantly above the market. The PE at the moment is probably still potentially a smidge too high, and that's why it might be due to obviously the 10-year yield and people easing off high PE stocks. Could be a reason. You add in also that the COVID kick to online players might be a reason. Market cap's obviously come down a little bit there. Net tangible assets per share going up. Interest cover very easy. Return on equity is quite high, but coming down. Potentially they've invested a lot more capital into this business, and that's why return on capital has come down. So overall, a pretty good looking business, right? Okay, revenues of 500 million. So you're paying, not so much money on a price to sales basis. Operating margin is still going up. Net profit after abnormal. So potentially they had some once-off charges there, and that's what brought it down. EBITDA of 47 million. This is a very healthy business, guys, and personally think it's a good buy. Obviously, just my opinion. I'm definitely not a financial professional. Don't be surprised though that at some point, once they hit market saturation, which I don't know if they've hit that yet. Me personally, I don't think they have. If they have hit it, then this will become a dividend-paying stock, right? The dividend yield should go up and the PE will come down. But as long as we keep seeing growth, that PE should stay healthy and potentially even expand. Let's quickly look at the balance sheet. They do have a little bit of debt here, 115 million in debt, but they've got tons of cash. So obviously, I'm obviously not fully across what happened during COVID, but they've obviously done a capital raising here or something like that. Inventories are up, which is why I believe return on equity would be down, return on capital. They've invested more money into this business. Now, inventory, having come from a retail background, I'd watch this number, because if it continues to expand and sales and return on capital kind of don't, if they keep dropping, people will penalize this business because it'll have too much money tied up in inventory. The issue with having too much money tied up in inventory is that businesses that have too much there, potentially the stock isn't good stock. It will eventually need to be marked down and sold at a loss or completely written off. That's the problem. That's why a lot of retail businesses go under, don't do well, is because they don't get rid of old stock. So what we need to work out is this good stock? Is this bad stock? And it might even be one of going onto the website and watching what's going on sale, what's not. Is there something that's consistently there that they're flogging and they're not getting much money for? Especially if it's TVs and it's low margin, that might not be good, right? Very hard to ascertain that, but that's going to be a key thing in working out if this business is going to do well long term, guys. Me personally, I think it's going to do well. Let's just jump into some recent announcements and have a look at what's going on. So actually, before we look at the announcements, guys, let's have a look at what Simply Wall Street's saying. So it's saying it's kind of quite good on health, past performance. It just seems to, dividend seems okay, value seems okay. So it's saying it's trading 2% below their fair estimate of value. Earnings are forecasted to go up 15%. Earnings grew by 120%. So if earnings don't grow by at least 15%, this will get smashed. Shareholders have been diluted in the past year, not great. High levels of non-cash earnings. So you'd want to kind of understand that a little bit more. Any reported profits that are not backed by cash, which the company has received. So that could mean that it's accounting profits there, which obviously isn't ideal, but not one to worry about too much yet. So this is saying it's trading a little bit below its fair value. It's not significantly more volatile. In the last 7 days, it's done decent. It's overachieved AU online retail and the AU market. Again, it's beat the market on a 1 year basis, so it's not one to be too scared about. I know a lot of the people that probably are scared about it got in this a little bit late, but what happened, guys, was these got ran up really hard because of COVID. Got very excited. I did as well. And obviously they've come down to earth, and look, eventually they will likely hit those highs again, but it just will take a bit of time. So be patient. This is a good business. And again, if you want to look at your returns, just have a look here, guys, and have a look at, 1 year, 3 year, 90 days is where obviously you've been hit hard and a little bit further. But the industry as a whole got hit in those 90 days while the market kind of overachieved. So potentially it looks like it might be turning. This has definitely gotten smaller. Industry has kind of recovered, so this has kind of lagged the industry, but who knows what they've put in that industry. So maybe turning, I'm not sold on it yet. It's probably around fair value, as they're saying here. I tend to agree with that. So it is below the industry average. Obviously it's not as fast growing as some of the other retailers like Temple & Webster, and potentially even MyDeal on a percent basis. Poor value on a PEG ratio, potentially it has contributed to as well. Price to book is fair. Now, if you extrapolate this out, guys, that's quite a bit of growth. I mean, if we go out to well over $1 billion in 2025, you're talking about quite a big business and 85 million in earnings. So as opposed to the 50 odd million that's forecasted this year and the 41 in the prior year. So doubling, which means that on that forward of a PE, it's trading on an earnings multiple of 15 times, obviously future earnings. So you need to be rewarded for holding that. So that's why obviously the price is where it is. So the industry, as we've said, online retail, set to grow quite fast. This company is set to grow not quite as fast, which isn't as good. So this is the main question, guys. Do we think that Kogan can keep growing its earnings? Me personally, I think they are able to. They've got plenty of categories they can go into, and their database is quite big now. So to acquire a new customer isn't going to cost them. They're not going to have to spend so much acquiring new customers because they've got a lot and they can keep selling to them, and then they can continue to invest in new customers. Looking through here, definitely a little bit of negative sentiment here, guys. Assets more than cover liabilities. So yeah, obviously not good that we've had debt here and dilution of shareholders' value, which isn't great. Let's keep going down. Management. So you'd want to watch, is the CEO selling any stock here? Obviously, founder-led businesses are a big tick here. That's definitely something I like and look for. David Schaffer's been there for over 10 years. Amazing as well. He owns a 5% stake. Kogan also sold down a lot of shares. I do remember that. But he still owns almost $200 million, 75 million here. So very, very good that insiders own a lot of stock. But obviously here, this definitely hit, right? 155 million in shares sold. Obviously some were bought, but people would be focusing on that for sure. Not huge amounts of institutional ownership here, guys. Cool, so definitely have a look there and see if there's anything you see that I'm missing, but that's my current analysis. Let's look at their most recent kind of earnings updates, and let's look at what this director's notice is as well. Nothing really on this notice. So we've had the dividend recently, director appointments. Okay, let's have a look at the presentation and see what's going on. So it looks like they had a really big Black Friday, over 3 million customers during that period. So gross sales growth of 97%, revenue growth, gross profit, adjusted EBITDA outperformed prior year by 88.6, 126, 184, and 250 respectively. The group finished with a cash balance of 79 million. over 3 million active customers, 719,000 active customers for Mighty Ape. Kogan Marketplace grew by almost 200%. There's really big growth coming here, guys. They've got Kogan Mobile, Kogan Internet. They're branching out into a lot of different bits and pieces, and they're going to make it hard for Amazon, trust me. So they acquired Mighty Ape, one of New Zealand's largest online retailers. That must be where the return on equity has been kicked in the nuts a little bit. And this is where you'd obviously want to see Mighty Ape perform quite well. You'd expect to see some kind of positives by integrating these two businesses together. And over time, this should improve earnings, right? All looks pretty good here, guys. Everything is in the green. As I said, we need to watch that inventory. We need to watch Mighty Ape and see, okay, what are they going to do with it? So it's a new phase of growth, right? But we want to see, was it smart for Kogan to go there and acquire these customers? Not sure. I need to work out what they paid for it, right? There's a bit of gaming here as well, which is cool. And you just can see here the different types of businesses. They're getting into pet insurance, super credit cards, furniture, even more electronics. They've made some nice acquisitions here. Just wanted to see this business keep growing up. Like, personally, guys, I think I wouldn't be worried. If you currently own this, don't be stressed. Not a bad time for a long-term holder to get in now. Don't be surprised on the short term if it drops a little bit more. Don't also be surprised if it rockets from here. I think this is a very good business based on what I've seen here, guys. And me personally, I'll be looking to further investigate into this business. I like it, guys. This is just my opinion. I don't know if you like this style of format. Please let me know if you do. Obviously, it's not as fluid or as well prepared, but I hope you've enjoyed the video nonetheless, based on what I've seen, guys. Very, very good. If you want me to do an even deeper dive, I'm happy to, but this in detail this goes through pretty fair amounts of detail here. If you want to understand this business, I'd definitely jump in and have a read through this. Initial glances, guys, I like the stock. Let me know if you like it or if you're a holder. And again, I'm not a financial professional, guys. I'm just doing this, sharing my opinion with you. I hope you enjoy it. If you have enjoyed it, please like the video. It really helps the channel. And subscribe to the channel. Thanks, guys, and see you in the next video.